hotel organizations and operations, you're going to have controllers and comptrollers. You're going to have a separate accounting office. The accounting office works directly with the night auditor, the front end manager, and the director of food and beverage operations, which are all the revenue generating areas. The final guest folios are posted and verified through accounting. So this lecture is just on general accounting procedures, which is known as GAAP, G-A-A-P, GAAP. And if you have basic accounting in your degree or whatever program you're in, basic accounting, you have to learn all the language and terminology. To be a certified public accountant, it's actually a pretty intense exam, but you have to, the first course that you would take in accounting is to learn all the terminology. So accounting allows us as direct line managers and director of operations to make good business decisions based on the budget. And we said a budget is forecast, which is history, plus projected revenue. So history plays an important part in creating the budgets. So it's going to identify our assets. Our assets is our revenue, and then taking into consideration revenue is our performance. How well do we perform? And we have expenses, and the expenses are required to help us generate revenue. So in your back office, you're going to have the accounting department. There will be a director of accounting. You'll have a vice president of accounting in a corporation that where all the statistics and numbers and information go to. GAAP is the general accounting procedures and practices that are recognized by local governments. And when we say GAAP, there are rules and regulations that accountants follow as a certified public accountant. So we're looking for the financial position, the financial plan. Now, not all of you will have access to the overall profit and loss statement. Each director, department head, or person in charge or responsible for their area will have their own piece of the overall budget. And then the budget is compiled and put together for the general management, the executive management team, and the accounting people. So the budgets are determined by quarter. We call these fiscal years, but the fiscal year is broken down into quarters, so you have 4 quarters. Many operations start in January, and some operations start in July. So depending on what company you work for, many people like to start their operations in July because it gives them a better snapshot of the fiscal year, because January is at the end of the holiday season, and most businesses in January are very slow after all of the holiday season, where people are spending a lot of money on either vacation, travel, gifts, events. So when after January for New Year, when the holiday, there's not a lot of revenue generated. So some corporations, you may start to see them, they start their fiscal year in July. And that just means that their first quarter starts July 1st versus January 1st. So we take a quarter snapshot. A quarter snapshot is managed and broken down so that you can see what your projected budget is for revenue and what your expenses are. So it takes a snapshot of that quarter. Okay. Now, when we say buy raw materials in your budget, if you're managing rooms division, you're going to have a projected revenue, which we talked about Monday with the revenue manager, and you had a revenue management assignment to determine how many rooms you can sell at what rate and what percentage of rooms are booked to generate your revenue. Now, the raw material in that revenue would be any product or supplies that I would need to operate that room. So we said toiletries, we said linen, sheets, pillows, all of them have to be laundered. Any supplies for if you have a kitchenette, they're going to have basic supplies. So these are materials that we need to operate. And in some cases, the turnover in these raw materials are not as perishable as they would be in food and beverage. So if you're managing food and beverage, your raw materials are going to be more frequently used and a larger inventory. So we have to convert them into a finished good. So a finished good would be, for example, would be that we order food, food goes to the kitchen has a menu, the menu has a recipe, the recipe cooks the item, it's served to the guest pays for it, then we generate revenue. That's the simple process of taking a product and converting it into a good sold. Now, there's a lot that goes into that good sold, which we're going to discuss a little bit more. So that's the general accounting practice. That's the basic. We have a product. It's a room. Room takes raw material to sell that room to the guest to generate revenue. Food and beverage, we take raw material. We have to create or prepare something to turn it into goods and services. And the same would be for the beverage. The beverage is the same. We purchase alcohol, we create a recipe, it's sold to a guest for goods and services. That's the simple accounting practice. We have revenue, but in order to generate revenue, we have expenses. And as a manager, we keep track of these. This is our job. Because if you don't keep track, you're not going to know whether you're making a profit or you're losing money. And you're not going to be able to determine where the money is going or how it's being spent. So direct material costs would be food product, liquor product, any materials and supplies to operate a room. If we have a convenience store and we're selling basic sundries, basic food products, in-room guest placements, these also be a raw material for revenue management. Now, direct labor, which we're going to talk about a little bit differently because labor is our largest expense, and the expense that managers don't manage very well is something that we have to take a look at. And to sell the cost of goods, we have to have labor to do that. So the component parts are an integral part of finishing the product. That's why when you have purchasing agents in these large operations, they do bids. And then when they do bids, they want the best price on the raw material that they can get. We all know what's happening in the world right now from the ramifications of COVID and the government. Inflation is happening. It's product supply and demand. There is a lot of demand for basic raw material, but there's not a lot of supply because at the production level and the manufacturing plants, there's COVID. At the farms, there's COVID. So the human labor is being reduced because of lack of employees. We also know that there's a great, we're hearing the term, the great exit from jobs. So employees are leaving their jobs and looking for new employment or better methods to gain financial revenue, and it could be that they're going to be self-employed. So we have to trace directly the product movement, the product flow. So if you can't trace these products, you're not going to be able to create or generate a revenue or a budget from that. So it's very important to understand your inventory, understand your distributor, your vendors, make sure you keep thorough vendor lists. If you know what it costs you to maintain and operate a room and how much toiletry is needed, the replacement of linen or the turnover in linen based on quarterly or annual fiscal responsibility, you can put this into a budget, knowing that in a certain period of time, you have to replace bedding, you have to replace sheets, and then in a certain period of time, you have to replace mattresses. And I gave you an example in one of our earlier lectures where we had to replace all the bedding in one particular property because it had bed bugs. So this particular property in the case study, which you all had, replaced all of their bedding. It was not in the budget. They didn't have it in their fiscal plan. So they had to go back and use emergency funding and emergency resources, which is another area where corporations will put money in the coffers off to the side for such emergencies. So direct labor, which is one of our expenses. So we have our product costs, which we said could be food, liquor, any supplies that we need to operate. Part of the product could be also for room repairs that engineering needs to buy, replacing air conditioners, replacing plumbing fixtures. All of this needs to be put into the basic um, upkeep of a room, and the basic how often do we need to maintain a room. And there's formulas and strategies in place for that. So payroll cost. So each of you took a project assignment in the related area that you wanted to study and possibly work in when you graduate, and you're going to take your profit and loss statement and you're going to look at it. You all did a job tree uh, of the department that you chose. So it was an employee tree of the director of that department and all the people, employees that are needed in that department. So that's your payroll. So if you were to write as an HR manager a manual for that department, you would have to write each job description for each person in that department, what the base pay is in the range, and how much you want to pay, whether it's salary or an hourly rate. Then you have to figure out how many hours they would work in that particular department. 40-hour week, 20-hour week, part-time, etc. Now, when you say, and you see that you say, well, I'm going to pay this individual $12 an hour to work in that department. Well, $12 an hour, that's not the final cost, because as an owner operator, you're going to have workman's comp insurance, you're going to have liability insurance, and you're going to have Social Security, all these other benefits that you have to pay by law for the government. So if you're paying someone $12 an hour, in all reality, you're probably paying that person $18 an hour with all the insurance and expenses and costs. So direct workers or line workers that directly influence the product revenue sales. So if you're a server, a bartender, you're taking that food and you're selling it to a guest. If you're a cashier in a C-store or convenience store, you're selling a product. If you're a front office or front end manager or front guest customer service, you're selling a room. If you're an event manager, you're selling a catered event. If you're a catering manager, you're selling a catered event. All these are direct line workers that influence the revenue that are part of generating our gross revenue and sales, but that's considered a cost, an expense. The cost employees do not work directly with the goods, are considered support. So your support will be your accounting department. Your accounting department is part of overall executive management, and they keep track of the fiscal responsibilities. Part of that will be your engineering department. Engineering doesn't necessarily generate revenue, but they're needed to upkeep the rooms, the kitchens, the facilities of the hotel so that we can sell our product. Housekeeping would be a direct. We need them to vacuum, clean the bathrooms, change the linen, wash the linen. This is all part of guest customer service, and it's an expected expense to operate a hotel. So these are indirect labor charges that we have to compensate for in our budget. So indirect materials, cleaning supplies, plumbing fixtures, replacement of beds, food and beverage. Indirect supplies are having the pesticides, bug companies, having again any kitchen equipment repairs. Indirect is in the dining room. After a certain period of time, you have to replace furniture, you have to replace chairs. You could have a compressor on a refrigerator go. All these are indirect materials that many managers do not budget for, and later on they don't even have an emergency budget or emergency coffer or kitty fund to have monies to pay for these. That's where businesses get into trouble. Regulatory costs are licenses, fees. Let's say for a bar, you need your liquor license, you need your insurance. All these are regulatory costs that are indirect expenses that people don't think of. Okay. Cost per unit. So once we determine a cost per unit, cost per unit means how much it costs me to sell a product. So it could be a drink at a bar, it could be a menu item, it could be a room, it could be an individual event. We should know for every one of our events what it would cost for a basic event, the venue, the type of venue, what it would cost per person. We should have an average of what it would cost based on a basic banquet event order form. Overhead, product cost, all this goes on to a basic balance sheet, which is done in accounting. When you go and do accounting, the balance sheet will tell you what all your expenses are, your basic inventory, and your basic revenue. It's a real basic way to get a daily snapshot. So there are many times when I would print out the point of sales from one restaurant and see that something was wrong, and I would have to go to accounting, have them go over each line with me. I had to do this on a regular basis for events and the banquet and catering sales operations because there are large venues that had a lot of expenses included in a banquet. And there were large corporations that had many expenses. So we had to make sure that we were getting the revenue and they were paying appropriately to make sure that we made a profit from that event. So goods sold, cost of goods sold, we did discuss that. The cost of goods sold is what it takes to sell something. Gross profit is revenue before EBITDA, earned income before taxes. That means that it's not a net profit. A gross means that if we take all of our expenses and all of our revenue, and that's our basic gross profit, but that's before earned income before taxes. So gross is not a true snapshot of the bottom line. So gross profit is not the bottom line. So it's all done within a period. A period, you have to have a measurement. Is it done quarterly, monthly, weekly, daily? We break it down in a point of sale system or property management system. We'll break that down for you. Raw materials is our inventory. That's why as a chef, a beverage manager, it's very important that you do a monthly inventory. A monthly inventory takes what we have on hand versus what we purchased, and it calculates what our cost is of inventory on hand. We have to account for what we have on hand as a raw material. So basically you've got a bottle of liquor on the shelf and that bottle of liquor costs you $30. Well, how many bottles of liquor do you have on the shelf that cost $30? You multiply that times what's on the shelf, and that tells you what your expenses are on the shelf. Then you figure out what possible revenue I could get from those 30 bottles based on your inventory. And that's why as chefs, we do a monthly food inventory, we do a monthly liquor inventory, and then we do our papers and supplies, because this tells us what we have as this is a perishable product that we have to account for. That's why if you buy a business and a person will say, well, here's what it costs for the equipment and all the supplies that I have, they'll have a separate inventory list of what exactly they have as far as revenue and product on hand. Okay, so raw material, finished good. Okay. So materials purchased, inventory, direct materials used, work in process. This gives you an actual, you'll learn food inventory and beverage inventory when you get into your financial management. It's a very simple process. It's basically telling you how much cash on hand you have. It's called cash flow, meaning that you're cash strong. If I was to take the food and sell it, or if I was to take the liquor and sell it, I would gain cash revenue. Okay, that's the cost of goods that are going to be sold. Okay, these are just general practices. So beginning materials or inventory on hand, materials that you're purchasing or their inventory, some that are going to be placed into production, how much money I can generate from that inventory, and then the ending materials, what will be left after I sell those for what product. So it doesn't mean that you're going to take your bottle times what it costs or what you paid for it, and that's what you're going to gain in revenue. You're going to gain a higher profit from that and determine what that cost is to gain that revenue. That's a simple process of thinking about it. Okay. So labor is the biggest piece to manage in operations. Labor. And most of you are going to be managing this on a daily basis. It's based on your daily budget. You forecasted so many people to come into the hotel. A snowstorm happened. The people aren't coming. You have to tell people to stay home because you have to control the labor cost. You have a restaurant. The restaurant has so many reservations. Something bad happened within the community. The restaurant is closed for that day. There might have been a water main or a pipe that broke on the road. No one can get to your restaurant. These are actual true scenarios that have happened. They can't get to your restaurant. The restaurant closes. All those reservations are canceled. You have to call your employees, tell them to stay home. You don't want them to come in. You don't want to pay for labor where you have no generated revenue from menu or beverage. So they have to stay home. So you're saving on the labor costs. That's managing the budget. So it takes labor, direct materials. Direct materials for in our business is room sales, food sales, beverage, or events. If something is canceled, or we say we had 100 we expect 100 reservations we budgeted for, only 50 reservations show up. The labor schedule was based on 100 reservations. That means we have to cut our labor force in half, operate a skeleton crew to take care of the guests that are on the books, but the rest of the labor we do not need based on our projected revenue. Again, you're managing the budget. This is a variable expense. Variable, it fluctuates with sales. So we have our overhead rate, our estimated projection, that's your forecast. And then you have to take your forecast based on your overhead projection. This gives you an activity base that you projected revenue or projected sales. So all of you do your budget. You base your budget on your forecast. You're going to work with your managers. Your budget is a moving document. Many people will say, well, you can't change the budget. You can't change the forecast. Yes, you have to as a manager, because we're in a perishable industry where people don't show. Reservations get canceled. Things happen. Snowstorms, event, human things happen where the hotel might be closed, shut down, or services may not be rendered. So you have to manage accordingly. So your accounting department will use variable numbers and projections. Variables are percentages based on cost or based on revenue. A variable is always projected in a percent or decimal. A decimal represents a percent. So the variable is based on margins. Margins always have to have cost or revenue. So when you see it saying variables, that's all accountants and statisticians do, is they take every variable and they project how much sales or cost it's going to be. And they give managers this information to work with. If I had this particular scenario, here's the variable margin. In our industry, we work on very close margins. In food and beverage, if you're showing a 3% margin of profit, you're doing very well, because most companies don't even make it to that variant. So cost of goods, again, is the finished perishable product, understanding what it takes to sell that product and complete it. Okay, so these are just examples of beginning and ending inventories. Okay. Okay, so this is a case study, which is also known as an empirical study. An empirical study is a study that doctoral students or statisticians do to gain qualitative or quantitative method information. Qualitative means you go out and you do inventory, you do surveys, you interview people to get information to determine a particular result from research. So financial forecast, so we said you have to have a forecast to create a budget. A forecast is the history of sales for a venue, and you break it down. For some of you that said you manage bars, bars, you break it down to a bar. Somebody said they manage restaurants, we broke it down to a restaurant. Your large resorts, they break it down into each individual restaurant, each individual bar, and it goes on a master profit and loss. So each individual food outlet or beverage outlet has to have their own forecast. Forecast is based on history. History is previous sales and events. What happened to generate those sales? What happened because we didn't have sales? A thunderstorm, a tornado, a hurricane. Up north right now with all the snowstorms. New Orleans with all the hurricanes they're having. So they shut down, they lose sales. Or we have the Super Bowl, we have the World Cup, we have the World Series, we have a big NASCAR event where all our hotels are sold out, the bars are all busy, so our forecast is higher. That's your history. You need the forecast to create a budget. The budget basically is telling us here's what we need in expenses to create a product to sell, revenue. So we have to determine what we think our revenue and our sales are. So we manage financial management and control of all operating expenses and revenue to determine our profitability, which we have to generate reports to send back to our corporate managers, the corporation we work for, or to our regional managers who manage for the corporation. And in a small department, it'll be your direct report, but you work as a team in a department. So as a director of food and beverage operations, I had a team. We all worked together. I had to work very close to my beverage manager, my event manager, my catering sales manager, and my restaurant managers. If you didn't have a good team, you're not going to have individuals that manage a good budget or a good forecast. So you have to have a good plan. And a good plan means that you're always 1 to 1.5% within budget plan. We forecasted very well. If you're way off 5% over or under budget, your corporation's going to throw up red flags. You're not budgeting correctly. They want you very close. So this gives you a projected level of sales. It alerts owners and operators of significant expenses that are on the horizon to predict shortfalls in revenue. And as we explained, if you know there's a shortfall before you bring in all this labor, or let's say a banquet, a major function cancels, the chef doesn't buy the food. The beverage manager doesn't purchase the beverage. You don't buy it because you don't need it and it's not going to be on inventory, so it's going to save in expenses. So to increase revenue, next week's lecture, we're going to talk a little bit more about sales incentives. Revenue is based on compensation. So we talked about that. If you're an executive manager or in a key role, your base pay plus benefits and bonuses. So you get more bonuses and compensations if you generate the company or the owner more money. Capital expenses. A lot of companies, you want a new refrigerator, you want your bar remodeled. A lot of corporations won't give you capital expenditures unless you're maintaining or above budget, meaning you exceeded plan and they put the money aside. You have an argument or a justification to get a renovation of a bar, an event, venue, center, anything like that, okay? So forecast is the history of the plan. The budget is after you take your forecast and you create a budget. Your budget is your monthly revenue, your monthly expenses, and you manage the budget based on your forecast or based on future business, bookings, events, reservations, okay? Long range budget is annual strategic planning. You could have a 5-year plan, which is a capital expense plan, meaning this hotel is going to be completely renovated in 5 years, but we need to put back into the coffers a certain percentage of money for that renovation to take place. If that hotel is not making plan and not putting money back in the coffers, it's going to cancel that long-term capital expense. So here's a study that was done. Limited response means they took a controlled group of people that they interviewed, a questionnaire, demographic information. So they took alike hotels, alike clients, and interviewed. Everything had to be similar to gain a controlled test group to gain correct knowledge. So random sampling was used, which means they took a random sample of people. They didn't go and pick and choose people. They did a survey in this time frame. They had a particular statistical data software they used. They got a less than 30% response rate, which is a third. They surveyed rooms at hotels that had more than 250 rooms. Their annual gross revenue was average of 10 million. And it said 60% said they had a budget and a financial goal. That means 40, well, here it says 45%, but that means 45% did not have a budget. That's huge. Okay. The majority of the respondents who used the budget declared that the operation budget was used for budgetary control, within 90% reporting that budgets were prepared for all of the hotel operations. Okay, so there's a little bit of leeway there, meaning that majority that did have budgets used 90% of them used to control the operations. Okay. A third of the respondents, food and beverage and labor costs within the range of 1 to 2%. So there you go, right there. There's your results. So 1/3 of them were within 1 to 2% of budget, and that's what your corporations want. Most companies are 1 to 1.5%. If you're out there in 3 and 5 and above, you're going to get red flagged, and you're going to have them. I mean, below or above. Above means that you gold bricked, you short changed them, that you hid something from the company, that you knew you had something coming up in revenue and you hid it from them. They're going to ask you, well, why are you so above budget? They want to know why, right? So try to be as close as you can. Even if you're hiding things or holding back that you know is going to come up and make you look good, well, do it in a professional way where you're still within 1 to 1.5%. Forecasting techniques. Some of the hoteliers use more than one technique for each department and method used. It varied, which it should be. For example, engineering, it's very hard to determine how many air conditioning units will go out. It's very hard to determine how many, toilet guts need to be replaced or shower heads need to be replaced. This has to be based on industry standards, industry reports, wear and tear. If you're buying cheap replacement parts, well, then you're going to have to replace them more frequently. One of the examples I gave you at the Kaloa Landing is when the laundry equipment went out. One machine after another went out within a month period of each. These machines cost $70,000 to $150,000 each, and they were a poor quality machine that was purchased. So the owner should have purchased a high quality machine that would have lasted 10 years. They bought a machine that the warranty was 5 years, and within 2 years they had to replace them. So 40% of the restaurants and beverage departments favored numeric of guests by expected. So basically this said, this is how many reservations we expect. This is the average check we expect the guests to spend. That's how they forecasted. 73% stated they applied techniques to the rooms. The techniques that I gave you that you did for revenue manager are industry standards. Some places might have a different formula they use based on their history, what they know. So that means they determined this is what our average room is per cost or per revenue, and this is what our average number of sales will be. 33% in the banquet department favored the last year's actual revenues. Well, that's what you have to do. So you look at last year's events and say, are these going to be repeat events, or what are these events? So if you're a wedding venue, you're going to say, we had 50 weddings last year. So do you expect to do 50 weddings again? Or was this a fluke? Or do you expect to do more? You did 50 last year, you're going to do 60 this year. These are all the things that you have to look at. Or if you're a conference center and you have contracts with major corporations, Sony or gaming.com, and they have regular venues at your hotel, and they have regular meetings, regular luncheons, and these are annual events. Well, that's going to be moved over. That's going to go into the forecast, get moved over to next year's forecast. Well, if it's a one-time event where Sony came in, they're out of LA, Sony went to Hawaii, the island of Kauai, they chose Kauai this year to have their event, they're not going to be back next year. Well, that's going to be taken off your forecast, But when you write your budget, there's going to be a line item where you're going to put an explanation saying Sony was a one-time year. It was 350,000 revenue in our sales that will not be um, in this year's forecast. Well, you're going to try and make up that $350,000 in a different group, a different event. You're not going to just say, well, it's zero, we're not doing anything. But when your executive management team looks at it, they're going to say, oh, well, here's what we did last year with Sony. We're not doing that again. So this has to be done. It's done on every year on a regular basis. It's done, it's reviewed on a quarterly basis. And a budget is a moving management tool. You're going to hear from many managers and many accountants that budgets are locked in. When they're done, you can't change or it's not moving. That's false. I've been doing operations for 40 years. It has to be forecasted, especially in the world today with all the events that we have going on, with the constant daily shootings, the constant variants of virus, the labor walkout. There's so many variants in having the forecast business today. So the higher sales level of property, the greater likelihood that the property had a long range budget, which you all will have a long range budget. The long range budget is for capital expense, equipment repairs, replacing of mattresses. We're going to go in and replace all the air conditioning units. We're going to upgrade all the lighting in the hotel. Hotel's outdated. We're going to do renovations. And I've been part of all these major projects and renovations as director of food and beverage in many corporations, and it's part of the budgeting plan. National chains might have to purchase more. You might have a long-term plan where you're going to buy real estate and build. So those are capital expense, long-term budgets, but you're going to say each partner hotel has to return so much on the margin on the bottom line into a account that's going to be used to purchase real estate and build hotels. Okay. Okay, so that's all we have there.